Hi class, this video is going to run through how to complete exercise 16.3 of our textbook, which you'll find on page 219 and in your workbook on page 289. This question is all about calculating and journaling reducing balance depreciation. So this question is going to assume some required knowledge from chapter 15 on how to record and calculate depreciation, but it's going to focus on the intricacies of reducing balance. It's quite, again, an involved question. There are 5 aspects, so it will take us a while. It will take us about 15 minutes to run through. But let's have a look at this question. Who are we? We are 5 Star Comics and Graphic Novels, and we have bought a new photocopier for the office on 1st of February. So we're going to highlight all the important information. 1st of February 2023 for $14,000 plus GST of $1,400. GST not relevant to the purchase price. The machine is to be used for 4 years, in which it is expected to be traded in for a new model. The balance day is the 31st of July, so that's our reporting period. So remember, dates super important for depreciation. And we know that it is reducing balance depreciation method. This will be told somewhere in the question. You might have to find it. And the rate we are going to use is 20%. That is the important information that we need to use, that we need to know. This is actually probably the more important part of the question, picking up all this information, identifying the dates, what is the method, what is the rate, and now we can start to calculate it. Question A asks us to calculate the depreciation expense be allocated for 31st of July 2023, 24, and 25. Let's remember our formula for depreciation expense for reducing balance. Our depreciation expense is going to equal our carrying value times the rate. And we know that our rate is 20%. So we need to work out what our carrying value is each time, remembering carrying value is the purchase price minus accumulated depreciation. So what is our original calculation? $14,000 for the first year. So we are working out 31 July for 2023. 14,000 times 20% equals $2,800. Now, hopefully you've tweaked on that there is not a full year of depreciation here. We bought it on the 1st of February, and we're calculating the depreciation by 31st of July. This is a bit of a trick question. We need to work out how many months have occurred, and it is 6. All of February, all of March, all of April, all of May, all of June, and all of July. So this can be a bit of a trick. So 6 months means only half a year. So our depreciation expense for 31 July is $1,400. That means our new carrying value for our next year is going to be 12,600 times the rate. So for 2024, our expense is going to be for a full 12 months, and it's going to be 12,600 times 20%, which equals 2,520. So it would make sense that even though it's reducing balance, because it's a full year of depreciation, that's going to have a bigger depreciation expense now. Our carrying value for 2025 is going to be 12,600 minus 2,500. So our new 2,520. So our new one for 2025 is going to be 10,080. And I've made a bit of a mistake there. 10,080 times 20. And that is going to be $2,016. So this is where we're starting to see our reducing balance. So we have 3 depreciation expenses that we've calculated. So let's highlight them so it's really clear. We have $1,400 for July 31st, 2023. 2,520 for 2024, and 2016 for 2025. Slowly reducing now, and we now have a new, our final carrying value, if we want to calculate that, is going to be 10,080 minus 2016, which equals our final carrying value of 8,064, which is what we're hoping to ultimately end up as our balance of our value at the end of this process. Now what we need to do is do our journal entries. And it's been a while maybe over the school holidays. What are our debits and credits? We are essentially creating an expense and also reducing our assets. Increasing an expense is going to be a debit, and we call this expense depreciation, and then we say what the asset was. What was our asset here? It is a photocopier. So depreciation of photocopier. And for 31st of July, you can see the date's already there. It is $1,400. We also have a credit, and this is accumulated depreciation. Now I'm going to do a few little abbreviations here of photocopier. And hopefully you can read that. Doesn't really matter because you can hear what I'm saying. We would then do a narration here, and I'm only going to do one narration here, so we have heaps of space. Our narration here would be an adjusting entry, because we are doing an adjustment to our assets, and we're doing it for 6 months depreciation. And it's really important that you say that this is reducing balance. We have now recorded, what have we recorded here? We'll do it in red so it's a little bit clear. We've recorded our expenses going up with a debit and our assets going down with a credit. And we're experts at Paler now. We've done our journal entries for our month for the period ending 31st of July 2023, but it also says for us to do our closing entries. And remember, what do we close? We close our expense accounts. How do I close a debit? I'm going to do a credit. So $1,400 again to remove our expense. What are we doing it to? We are transferring it to our P&L summary account. Remembering this is part of our expenses now. And we are then going to close our expense account by doing a credit, of depreciation of photocopier. And our narration here, because it assumes that we need a narration, just closing entry is fine. That's what we need to do for each of these years. We will do the next ones a bit quicker, and I won't do any narrations, but you will in your answer. 2024, we had $2,520 worth of depreciation. Again, it's the same entries, depreciation of photocopier. And our credit is accumulated depreciation of photocopier. And as much as possible, don't abbreviate. I'm doing it just to make it a little bit easier because there's not much space. We also need to do our closing entries, which is again P&L summary and depreciation of photocopier. Now you would also do the narrations, a same thing, adjusting entry for 12 months depreciation, reducing balance, closing entry. We're not going to do this to save space. And then on the 31st of July 2025, we know we have our final one. And yes, it does get a bit busy, $2,016 here. We've calculated it from here. Again, the same entries, depreciation of photocopier, accumulated depreciation of photocopier, And we're also going to do our closing entries. P&L summary, depreciation of photocopier. Now we have done all of the closing entries and depreciation for the 3 years. And if we just do a quick reflection, what have we done? We have again increased our expenses each year by a reducing amount because it's reducing balance depreciation. We've reduced our assets by a reducing amount, but we're acknowledging this. And then we are ticking this off and making our expense accounts zero by transferring it to profit and loss summary each time so we can start the scorecard again and ultimately keep reporting our profit. And we know depreciation of photocopier will be in our other expenses in our income statement. Part C asks us to prepare the following general ledger accounts: photocopier, depreciation of photocopier, and accumulated depreciation of photocopier. I'm going to do this at the end because there is no space on this one. I'm going to go to a new tab. But ultimately, all you're going to do is pick up all the information from our general journals. If it's a debit, you're going to write it on the left-hand side of your ledger. And if it's a credit, you're going to write it on the right-hand side of the ledger, and you're going to be really careful with your cross-references. What I'm going to do is go straight to D, which asks us to prepare a balance sheet extract to show how the photocopier would be reported in our balance sheet. We know that we bought our photocopier for $14,000, but we know as each year passes, our asset is not actually worth that amount. We are using up its revenue generating potential, and we're recording it going down through this accumulated depreciation. Now, this accumulated depreciation is an estimate. It's not necessarily verifiable. So we put two bits of information. We want to put the verifiable purchase price, which was always $14,000 for each of our years. That purchase price never changed. But we're now going to write the accumulated depreciation to faithfully represent how much we think our asset is worth. Our accumulated depreciation after the end of 2023 is just $1,400, which means our asset is worth $12,600, and this is our carrying value that we reported, that we used in our calculations to work out our depreciation expense. Our accumulated depreciation after 2024 is our $1,400, but also our now $2,520 that's been added. And if you add those up, it equals $3,920. So our asset is now worth $10,080. Where was this number important? In our calculation there. Finally, if we add all 3 years of depreciation, that's going to equal $5,936 because we add 2016 to our 3,920. And that gives us our end result of $8,064 being, if we remember correctly, what we thought our correct answer would be when we worked out our carrying value for the end of 2025. And that's how you would report it in your balance sheet. Before we move to our ledgers, let's finally do some thinking. Do you think the reducing balance method is appropriate for depreciating a photocopier? Explain your answer fully. We need to think about, is our photocopier's ability to generate revenue equal throughout its lifetime or not? Is it better at generating revenue at the start of its life or at the end of its life? Now, if it's more beneficial at the start and uses up more of its revenue generating potential, then we would use reducing balance, and that is absolutely appropriate here. We know photocopiers are very efficient when they're new, and they would be at their maximum earning potential in their first years of use. As they get older, as we know, photocopiers are more likely to be prone to breakdowns, be less efficient, and therefore their revenue earning capacity is going to be reduced. Hence, it's more appropriate to use this reducing balance method like we have, because we're recording higher expenses and a higher reduction in the asset value at the start as we're using up its value. Have a look at the solutions to that. I've waffled on a bit, but that would be something you would talk about. Now we come to our question 3. Question C, let's pick up all the information that we've just used and record it in our ledgers. And if you see on the right hand side, and I'll highlight it so it's really clear, we actually have the correct general journal entries, and luckily for you, they are much neater than how I write them. This is how you can check your answers. You can see these also have narrations. We now need to pick all this information up and record it in our ledgers. We have 3 ledgers that we need to consider. Photocopier, so that is our asset. Depreciation of photocopier, our expense. And accumulated depreciation of photocopier, our negative asset account. Let's make that really clear. We have our asset, we have our expense, and we have really our negative asset ledger. Now, we know, because we are experts, debits are on our left and credits are on our right. So we're going to use all the information that we know from this transaction and the lifetime of this photocopier to record all the things that are relevant. And we're going to use, for the most part, all the information in our general journal. However, the first one you'll see is for the photocopier ledger, and you'll see the one entries we've done, we've never written photocopier once as that one. We've only ever written depreciation of photocopier and accumulated depreciation of photocopier. So what do we do here? We need to recognize on the 1st of February, and you can see there's a hint there, what did we do? We bought our photocopier. This means our asset has gone up. Assets going up are debits, so we have to record that as $14,000. How did we pay for this? We paid for it with cash, so that would mean our credit here would be cash at bank, so that's our cross-reference. Now all we're going to do is go through and follow the instructions and pick all the information up. The first one we have is depreciation of photocopier. It is a debit of $1,400. $1,400. And we are going to do this as a debit. And our cross-reference is the other side of this transaction. We're going to say what our credit was. What is our credit? Accumulated depreciation of photocopier. That's all you need to do. Our other side of this is we're going to find our credit. In this case, it is our accumulated depreciation of photocopier, $1,400, and this is going to be just depreciation of photocopier. So we've ticked those off. Let's tick them off as we go. We're now going to follow the information here. Now, there is no ledger that we've been asked to do for P&L summary, so we can ignore the debit, but we do need to record the credit of $1,400 in our depreciation of photocopier, which is with our cross-reference of P&L summary. And this is how we've closed this ledger. Remember, this is our expense account. We need it to be 0 or balanced at the end of the period to start again. We have done that. We don't need to do anything in terms of balancing this one. But what we do need to now do is record all the other information. We will now then go on to 2024 and do the same thing. This time it's 2,520. And we are going to do our P&L summary here. You wouldn't do this, I'm just making it a bit shorter. And then we're also going to then do the information for our accumulated depreciation of photocopier, which is 2,520. And again, our cross-reference is depreciation of photocopier. And I'll come back to this one in a second. We have recorded our credit of 2,520. So right-hand side, our cross-reference is depreciation. Now, this one has asked you to balance this one. I don't know why it hasn't asked you to do this in 2023, but that's okay. What do we do when we balance? We add up both sides and we put the biggest on each side. Clearly, this side is the only one that has a value, so it is the biggest, 3,920. That means we have to find the number that balances it, in fact, all of it, and then carry this down to the first day of the next month and say our balance. What is that saying? It is saying we have 3,920 of accumulated depreciation on 1st of August 2024. And if you remember to our balance sheet, that's how much we said our asset had gone down by this date. So it's all starting to tie together. 31st of July 2025, we are again going to do our 2016 here to record the depreciation and close it off. We are again going to record our asset going down 2016 with depreciation of photocopy. Sorry, that's not very clear, but hopefully it's clear and you can check your solutions. We are again going to balance it. In this case, we're going to add this up, 3,920 plus 2016 equals 5,936. 5,936. Nothing above it, so we're going to have a new balance. And we're going to roll that accumulated depreciation balance down to the end to again say that on the 1st of August, we are going to have a accumulated depreciation of 5,936. Let's do a quick check. What did we buy our photocopier for? $14,000. If we say we have had $5,936 of depreciation, that means our asset is going to be worth at the end of the day, or we are estimating it to be worth $8,064. And that, if you remember all the way back to part A, is what we estimated it at that stage. Now guys, that is quite a complicated question, lots of moving parts, journals, ledgers, 3 years, different months. So quite complicated. I've gone through some of it relatively quickly. It might be hard to see on the video, so you might want to check your solutions. But that is how you do a complicated question on reducing balance depreciation. Keep practicing, keep building your skills, and you'll be a master of depreciation in no time.